Hey, what's up? My name's Christian. I'm a CPA and senior financial analyst, and in this video, I'm going to do a full discounted cash flow to put a price on Nintendo stock, as well as sense check it at the end with a reverse discounted cash flow to make sure that what we've done sort of makes sense. So if you're interested in financial analysis, business analysis, and some of the books and ideas that shape how I think, make sure to subscribe and let's just jump into it. So when it comes to reporting segment revenue, Nintendo only reports two different segments. They have their dedicated video game platform revenue and their IP related income, which is things like their movies and licensing revenue and things like that. But what I want to do before we really build out the discounted cash flow is actually break this dedicated video game platform number down into three more segments: the hardware, the first-party software, and then the third-party games and the Nintendo Switch Online and stuff. And the reason we're going to do that is because using that numbers, we're going to try to back calculate what the margins on those products are, and that will help us when we build out the full discounted cash flow in terms of being able to input some more clear ideas of what we think is going to happen to Nintendo going forward in the future. So what I've done here is I've just taken their total revenue and then that IP related sales number that we just saw. And then if we just scroll down here, Nintendo reports their digital sales total. And if you look at note 2, they call out that this 54.6% is the proportion to total dedicated video game platform software sales. So if we take their total digital sales and then we take that 55%, the implied total software sales that Nintendo makes is 741 billion yen. What we can then do is go down to page 7, which is the next page, and we can see that the proportion of first-party software sales is about 75%. So if we take that, we know that of that total software sales, 556 billion Japanese yen come from first-party software sales, and then the remaining amount would be their third-party sales, Nintendo Switch Online, and any DLC content. So I think that's pretty useful as is. And then if we just take their total video game platform revenue and we subtract the total software sales, then we know that the total hardware sales is roughly 1.5 trillion Japanese yen. After we've done that work, we actually have like a very nice breakdown of these different segments that are implied in Nintendo's numbers. And we can actually back calculate just estimated inputs on what the gross margin of those segments might be. And the weighted average of those is 39.5%. And we can see again on page 7 here that their gross profit margin is 39.3%. So we're pretty close by going off this. Now, the last thing that I want to do that I think is important if we're forecasting Nintendo's numbers is to actually get an idea of their ASP, or the average selling price of their product. And we're not going to be able to do it for every segment, but we're going to be able to do it for the important segments, hardware and first-party software. So if you go to page 12 of the financial explainer, what you'll see is that they sold 19.8 million Nintendo Switch 2 consoles in FY26. Now, I'm not going to include the Nintendo Switch here. You could do it, but in my mind, that console is being phased out and it's not a massive part of the mix. So maybe technically you should do it, but I think just leaving it out is easier and it's not going to make a huge difference. So if you just divide their total hardware sales by the hardware units that they reported, your sort of ASP on the consoles would be 75,000 yen, which is almost $500 US. And if you look at the price of a Switch, it's pretty much the exact same. So I'm pretty happy with that number for this model. We're not going to get everything perfectly right when we model it, and we're guessing on the future. So already based on that, we're going to be wrong. As long as we're sort of ballpark in every way, then we can at least know whether or not we're comfortable with the current price of Nintendo. If we do the same thing for software, we get an ASP of about 9,600 yen, which is about $60 US. And again, that's I think pretty close to what it is in reality. So let's take those inputs and we'll start to actually do some forecasts here. So obviously the first thing that we have to do when we're building out a discounted cash flow is forecast the revenue. So we're just gonna go through every segment that we just broke out and forecast its sales over the next 7 years. And I'm choosing 7 years because that is roughly the length of what I think a console cycle would be. The first thing I did was add 7,000 yen to the ASP that we calculated. That's around 50 bucks. And that's because Nintendo announced that in September, they're going to be raising the price of the Switch. This is the Canadian announcement, but they're doing the same thing in the USA as well. So we're going to factor that in. And then based on their forecast for the year, they forecasted a 17% drop in the amount of hardware that they're going to sell. Now, if you watched the last video, you'll know that Nintendo tends to miss on their guidance by about 15%. In the last couple of years, they've actually over forecasted, but last year they under forecasted. So it goes a bit in both directions. I'm just going to factor in a 10% drop in hardware. In FY28, I've given them a little bit more of a price bump just because this technically takes into account sales of the Switch 1 as well, and that is going to be phased out over the next couple of years. So a very honestly immaterial increase in the price, and then I'm just putting in that they're going to stay flat. If you look at the Switch 1 cycle, they have this nice growth, and then they get this big bump here in the second or third year of the console cycle, mostly I think because of COVID, but then it sort of just flattens out, and then you see that slow drop off that we expect from a console cycle. So all I'm saying is that I think they're just going to be a little bit flatter than they were in this previous cycle because there's no sort of pandemic, I hope. And then after that, we'll see this slow drop off in their console sales over the rest of the cycle. Then what's really important is that in the last year, we sort of normalize it for what we expect going into the future, because the last year of a discounted cash flow is applied to your terminal growth rate that you set. So if you put this in as like a low year because it's the end of the console cycle, or a really high year because it's the first year of a new console cycle, you're gonna pretty badly misjudge what the terminal value of the business is, and that's gonna lead to some bad outcomes. So I've sort of normalized it. I've added a little bit of a price increase just because I would expect the next console to be more expensive than the Switch 2. And then the number of hardware units is kind of just the average of the Switch 2. I don't want to add too much hardware units to this, especially yet, because we're so early in the Switch 2 cycle. And truthfully, the console gaming market is quite mature at this point. Maybe there's some opportunity for expanding into Southeast Asia. But the problem with that, when you look at this map, this is the average monthly income for people in that part of the world. And frankly, it's just quite low. I don't really know how much of a market there is for Nintendo to grow into here. Maybe they can, that would be great, but I don't want to put it into my model. We'll do a similar thing with software. I won't bore you by walking you through all of it, but it's a pretty similar story. I'm expecting them to have quite a bit of software growth in the next couple of years because there's still a 3D Mario game to come. There are Pokémon games that are going to come. And I just think that they have some big titles in the backlog that they're going to be able to sort of pump their sales up with in terms of that first-party software. For the third-party software, the Nintendo Switch Online and the DLC, I'm going to go with a pretty conservative 3% growth rate. That is because Nintendo reports their annual playing users of roughly 130 million, but that number hasn't really gone anywhere for the last 3 years or so. So I'm not really expecting that their user base is going to grow by too much. And in one of the previous videos, we sort of looked at how the demographics of Nintendo's player base are changing. And I'm just a little bit wary of how many more people they can add to their platform. Again, they very might be able to do so. I think Nintendo is an amazing business, but I want to be conservative in my assumptions here and not just bake in some amazing results. So 3% growth sort of factors in more DLC sales, growth of their third-party marketplace, and the ability to upsell the existing player base into the higher tier of Nintendo Switch Online, which is more than a doubling of the monthly price of that membership. So that would be pretty material if they're able to do that. I think 3% is quite fair. In terms of the IP-related revenue, this is really the whole debate around Nintendo and the story that you have to get comfortable with yourself when you're modeling it. What we know so far is that the Super Mario Galaxy movie was extremely successful. The previous Mario movie was extremely successful, and they still have a Legend of Zelda movie coming out in 2027, as well as all the merchandise and everything that is going to come with that. So I've put in 30% growth in FY27. If we look at their historical numbers, in FY24, their revenue was like 100 billion Japanese yen. and 30% growth off of FY26 with the Mario Galaxy movie doing similar numbers would put them at 95 billion Japanese yen. So I think that's pretty ballpark and still conservative. And then I would expect even more growth because we're getting the first Zelda movie in FY28, and I think that will be pretty hyped. After that, I would expect it to start tailing off. Maybe they release more things and they're able to get like a regular cadence and to get more licensing revenue through their theme park agreement with Universal, but I just don't really know. So what I want to do is just sort of bring it down to a nice average. Actually, to be honest, I might just bring it down a little bit more to 91 billion Japanese yen, and then just steady 3% growth from there, I think is also totally fine. So that gives us our total revenue number every single year. And then what we need to do is just apply those gross margins. So I don't really think there's going to be too much of a change in the gross margins. The hardware margins, I think, are going to be a little bit lower in FY28 because of that price increase, which is coming off the back of a supply in memory prices. So I want to factor that in. I've just brought it down to 9%, but I think over the course of the console cycle, that will recover to what it was historically. First-party software, I left it at 85%. There is a shift to digital mix happening, which should improve their margins a little bit, but I'm not really sure on how material it's going to be. We could bump it up to maybe like 88% or something like that. I think that's fair. Maybe it's more of a rise over time where we go 86, 87, 88, and we just cap it there. And then the rest, I'm not going to change either. I don't think their IP-related margins are going to change very much, and neither will their digital sales. So that gives us our gross margin, and then that can come into the actual discounted cash flow. Again, I'm not going to walk you through every single thing, but I think that operating costs will stay more or less the same as a percentage of revenue because Nintendo has shown over time a good discipline of keeping their costs stable. Tax rate, I don't think will change at all. And then I'm going to do something that I think some people might disagree with. I'm going to include equity income here because most of it comes from Pokémon. And I think that Pokémon is just a very integral part of the Nintendo family, even though they don't own it outright. And it comes through equity income because of that. But I don't think you can really get a proper valuation of Nintendo without considering their ownership of Pokémon. So I've added that in here. Now, Nintendo's growth in equity income has been absolutely insane over the last year or two, and that is really because of the Pokémon trend that is happening right now. To be honest, I don't really get it. I like Pokémon. I have this little thing up here that I got before going to Japan, but it feels a little bit like bubbly to me, but I don't know how long I can see this crazy amount of money coming in for them going forward. So I'm just going to put in a drop of 40% on that equity income, and then it'll be stable the year after, and then another 20% drop. And then it'll be sort of back to the baseline that we were seeing before, maybe a little bit higher with slow 3% growth. I don't know, maybe that's too conservative. That's what I'm thinking. If you have more insight than me, then let me know in the comments. Now, what we really should do if we're doing this the right way is actually take that equity income back out because that's an accounting measure. It's not cash flow. But like I said, I'm gonna leave it in because I just feel like Nintendo and Pokemon are so integrated that it just has to be considered. So I'm not going to back it out, but just know that this isn't really like a proper discounted cash flow. Nintendo only gets cash from the Pokemon company if the Pokemon company pays them a dividend. So interpret that however you want. We'll add back depreciation, we reduce their CapEx going forward, and then we get their normalized free cash flow. We discount that back, and that gives us the discounted cash flow. Couple more key inputs here that I need to sort of communicate to you. I'm using a 9% discount rate, and I talked about that in another video that hopefully will pop up over here that you can watch. But the discount rate is like a really material input on this analysis. And truthfully, if you're doing it the proper way, you should use a weighted average cost of capital. And if you did that for Nintendo, because the cost of debt is so cheap in Japan, and Nintendo is technically quite a low volatility stock, you would probably get a discount rate or a weighted average cost of capital lower than 9%. But I'm using 9% because I feel that is my opportunity cost. That is what I can get from a low risk investment in an index fund. And for me, I feel like that's the proper way to do this. Again, you're welcome to disagree. The other really important input is your terminal growth rate. I'm going with 2%. Actually, I'm gonna go with 3% because I think that Nintendo is a high moat business. I really don't see it being disrupted in the future at all, but I think there are some dangerous trends that they are going to have to navigate, including the changing demographics of players and what kids like. I talked about that in more detail in one of my earlier videos, so you can go and watch that, but I'm going to go with 3% here. We add back their net cash position, and based on all the inputs that we put into this discounted cash flow, what we're saying is that the price of Nintendo's stock should be about 7,200 yen. The current price of Nintendo is 599 yen. So quite a bit higher. That is like a 20% premium or something like that. But it was recently about 6,500 yen. So would that have been a buy? I'm gonna say no, actually. Even at its most recent low, I still don't think it would have been a buy because there was no margin of safety in that price. It was below our implied price, but not below the 25% discount that we wanted to get on the business before buying. And that margin of safety is so important. It's like a fundamental, because if you don't have that, you're not giving yourself any room for error in all the work that we just walked through on this discounted cash flow. Because like I've told you throughout it, there are mistakes in here. I'm not able to predict the future. So you want to be able to make sure that you're getting a price below what you think the price actually is, in case you've made those mistakes. And in case you're way off, your downside is going to be limited. And if you're right, your upside is going to be even more. So the margin of safety is just really fundamental, and you can't ignore it. What I've done here is just convert this price to the valuation of the Nintendo ADR, which is what you would buy it if you're in Canada or in the USA. And that trades at a 4-to-1 exchange ratio on the number of shares outstanding. So you convert it to USD and then you multiply it by 25%, and that gets you the buy price of the ADR at $8.52, which if you go look at the chart, it hasn't been at. The last thing I do is I always do sensitivity tables, or I try to, because it shows you how sensitive your buy price and your valuation is to the discount rate and the terminal values that you've put in. Because for a mature company like Nintendo, actually like 50 to 70% of the value of the business in that price comes from that terminal growth rate number that you set. And the amount that you discount those cash flows back also is super material. So if you look here, if you just put that discount rate to 7% and you used a 4% terminal growth rate instead of 3%, your implied value of Nintendo would actually be 12,000 yen, and the buy price would be 9,000 yen. So that gives you a sense in how confident you can be in these numbers. And for me, I don't know if I should be using a 3% terminal growth rate or a 4% terminal growth rate for Nintendo. So the fact that that number makes such a big difference in whether or not I buy it makes me less confident in whatever decision I end up making. And that is something that's really important for you to keep in mind as well if you're doing the same sort of analysis. Now, the other thing I want to quickly show you, and I just used Claude to make this into like a web page, but this is what's called a reverse discounted cash flow. So if we put in basically all the same inputs from our discounted cash flow, but I've just increased the projection period to 10 years instead of 7, you get a 14% free cash flow growth rate over the next 10 years. So Nintendo would have to grow 14% every year for the next 10 years for the current price to make sense. Now, that is quite a lot for a mature business. If we look at their net income over the Switch 1 cycle, which keep in mind was basically their most successful console of all time and included a pandemic where everyone was locked inside and gaming was like one of the only things that you could do, which was a massive tailwind for them in that year, their net income compounded at about 17% a year over that period. So that's not to say that they couldn't repeat that again with the Switch 2, but it is a lot to ask of the stock. So right now, the current stock price is quite optimistic at these levels. Again, I've got a couple sensitivity tables down here so you can pause it and take a look. But for me, at the current price, I think Nintendo is pretty expensively valued. I think maybe at the recent low, it was more or less fair valued, but it wasn't a discount and there wasn't a margin of safety. So that's pretty much the video. I hope you enjoyed it. I hope you learned something. This was a bit more of a technical video. I usually do more qualitative things. So if you're interested in that, please subscribe. I'm trying to hit 100 subscribers. So I would appreciate the support, and thank you for watching.